Hi everyone, I'm Matthew.
And I'm Marianne.
Today we're going to be talking about vehicles. And no, I don't mean motorized vehicles, I mean investment vehicles.
An investment vehicle is a product that an individual can invest in to grow their money. There are many types of investment vehicles, but let's keep things simple and split them into two main categories, direct and indirect.
We'll start with direct investment vehicles. Just as the name suggests, these involve directly owning and controlling specific assets such as stocks or bonds or even alternative asset classes such as real estate. These type of investments can be offered by both public and private companies. Since private securities usually require large sums of money and are often limited to institutional investors or wealthy individuals, you will likely be investing in securities of public companies. Starting off with stocks, these represent share of ownership in a company. When you buy a stock, you're getting a piece of that company. If the company does well, the value of your shares can increase, and you might also receive dividends.
Another way to build your wealth is through bonds. As you would have learned in previous Money Gains videos, a bond is a loan provided by an investor to a company or the government. When you buy a bond, you're lending money to the issuer who promises to pay back the money borrowed with interest.
Although direct investment vehicles are an excellent option, constructing a portfolio of stocks and bonds on your own can be a daunting and time-consuming task. Not only does it require extensive research and market expertise, but there are several things to consider, like diversification. You want to consider asset allocation, exposure to different geographies, sectors, market caps, and even investment styles.
To some, this may sound overwhelming. As a result, many investors consider indirect investment vehicles. They are called indirect because with them, you are outsourcing the process of constructing a portfolio to investment professionals. This means that they are the ones purchasing assets, not you.
Speaking of indirect investment vehicles, we can further divide indirect investment vehicles into two categories, public and private. Let's start off by looking at public ones. Public investment vehicles are those that are available to the public, including products such as exchange-traded funds, also known as ETFs, mutual funds, and segregated funds. Of these three investment vehicles, we typically see mutual funds and ETFs grouped together. So let's start there.
For many investors, mutual funds and ETFs represent a cost-effective way to build a diversified portfolio of stocks, bonds, or other investments. Most mutual funds and ETFs invest in asset classes such as equities and bonds, but they can also invest in what we call alternative asset classes, things like commodities and real estate. Although mutual funds and ETFs are similar in this sense, there are a couple of distinct differences between the two.
First, these two products are priced differently. A mutual fund's value is referred to its net asset value, also known as its NAV. This is calculated by taking the mutual fund's assets and subtracting its liabilities. When the mutual fund's NAV is divided by the total number of units outstanding, that gives you the price you would pay per unit for the mutual fund.
You may be wondering, how often is the NAV calculated? The NAV is calculated every day once the market closes. This means when you make a purchase of a mutual fund, regardless of when you place the trade that day, the price you pay will be the one that is quoted at the end of the day.
Now, unlike mutual funds, ETFs are bought and sold like a company on a stock exchange. The shares of an ETF are priced throughout the day, and therefore their value varies continuously, as is determined by supply and demand in the market. The number of outstanding shares of an ETF can change daily because of the continual creation of new shares and the redemption of existing shares. That keeps the market price of ETFs in line with their underlying securities.
So it sounds like the way these two investment vehicles are bought and sold is a key differentiator. Are there any other notable differences between them?
That's a good question. As you would have learned in a previous Money Gains video, some other differences are how they are managed and the costs associated with them. If you remember, historically, mutual funds have been known to be actively managed, which means there's an individual or group of individuals selecting securities for the portfolio. As a result, mutual funds tend to incur higher costs. On the other hand, ETFs have been typically labeled as passive investment vehicles, meaning they tend to track the performance of an index. As a result, they tend to incur lower costs than active mutual funds.
So we've covered mutual funds and ETFs. Now we'll move on to the third indirect public investment vehicle, segregated funds. This type of investment fund, which is offered by Canadian insurance companies, combines features of both insurance and investments. Typically, these types of investments are suitable for investors who are more conservative or those who are approaching retirement and want to protect their retirement savings.
Like mutual funds, segregated funds pool money from many investors to invest in a diversified portfolio of stocks, bonds, and other assets. However, they tend to come with a guarantee provided by the insurance company. This means that a portion of your initial investment is protected, even if the market goes down. The guarantee is usually between 75% and 100% of your investment, and it applies after a specific period, often 10 years. So we've covered public indirect investment vehicles. Finally, we have private indirect investment vehicles, such as hedge funds.
A hedge fund is a pool of money that attempts to earn a high return by using complex and riskier investing techniques such as short selling, leverage, and derivatives. To invest in hedge funds, you must be an accredited investor with a high minimum income or asset levels, as they are less regulated than mutual funds. Now that you have learned more about the different types of investment vehicles, it's time to start considering which one is best for you.
Whether you choose to construct a portfolio directly or indirectly, there are three key things to keep in mind. Firstly, know your goals. For example, is it a short-term goal like a vacation you want to take, or a long-term goal like retirement?
Next, consider your risk tolerance. Ask yourself, am I comfortable taking on more risk for potentially higher return, or am I more risk averse?
And lastly, stay diversified. Ask yourself, do I have exposure to different asset classes, geographies, sectors, and even investment styles to help mitigate risk?
We hope you enjoyed learning more about investment vehicles.
Make sure to continue following our videos to learn more about investing. Have a great day.